Hey everyone, and welcome back to The Explainer. Today we're zooming way out to look at the absolute foundational concepts of the global economic engine. We are talking about macroeconomics. Instead of just looking at individual choices, we're looking at the massive interconnected whole. We're going to analyze entire countries and literally millions of people all at once to really understand the broader forces that are shaping our world.
Okay, let's dive into this. Have you been to the grocery store lately or maybe looked at rent prices and thought, wait, why does everything feel so much more expensive than it used to? Or, maybe you've wondered why interest rates suddenly jump out of nowhere, or why some countries seem to grow so much faster than others. Well, that frustration and curiosity you're feeling, that is macroeconomics in action. You see, while microeconomics focuses on those zoomed-in individual decisions like, why a specific brand of coffee costs exactly what it does, macroeconomics asks why the general cost of living across the board is rising. It exposes these invisible, big-picture forces that directly affect your purchasing power, your loans, and even your job opportunities over years and decades. It's like looking at the entire forest instead of just one tree.
So, here is our roadmap for today's explainer. We'll start with the economy as a system, then look at the forces of inflation, governments and central banks, the global economic stage, and finally, measuring growth in recessions.
All right, let's jump right into Section 1, the economy as a system.
To truly get macroeconomics, you have to embrace the fact that absolutely everything is connected. Production, income, spending, they're not isolated events. And this brilliantly illustrates the circular flow of the economy. When a company produces goods, they pay wages to their workers, right? Well, those wages become income. The workers then turn around and spend that income on goods and services, which creates demand, which then encourages companies to produce even more. Money and goods are just constantly moving in this massive circle between households providing labor, firms producing goods, and governments collecting taxes. If one part of this loop slows down, say people get nervous and consumer confidence drops, companies reduce production, workers earn less, and boom, the whole system feels the impact.
Moving right along to Section 2, the forces of inflation.
Now, the primary friction in our beautiful economic loop is inflation. That's when prices persistently increase and your money just loses its purchasing power over time. There are four main forces that trigger this. First, you've got demand-side inflation. Basically, buyers want way more goods than the economy can actually produce. Second is supply-side inflation. This happens when it becomes more expensive to produce goods, maybe because of an energy spike or a broken supply chain. Third, monetary inflation, when central banks expand the money supply faster than the economy is actually producing output. And finally, and this one is wild, expectations and psychology. If people simply expect prices to rise, workers demand higher wages, businesses raise their prices in advance, and it actually turns inflation into a self-reinforcing cycle.
Because inflation can sound a bit abstract, we need a concrete way to measure it. The most common tool among official economic metrics is the Consumer Price Index, or the CPI. Statistical agencies track the cost of a theoretical basket of everyday goods, stuff like food, housing, energy, transportation. But hey, keep in mind, this is just an official average for a typical household. If you're spending a huge chunk of your income on rent and groceries, and those specific prices are spiking, well, your personal inflation rate might feel way higher than the official number. You absolutely aren't wrong. You're just experiencing your own personal inflation.
And this brings us to a really powerful reality check. Inflation is sometimes called a hidden tax on savers. Think about it. If you park your cash under a mattress, or actually, even if you just leave it sitting in a basic checking account, the numerical amount stays exactly the same, right? But its tangible real-world value is shrinking every single day. The longer high inflation lasts, the more of your hard-earned purchasing power literally just evaporates. It completely forces people to rethink how they save, spend, and invest.
All right, let's get into Section 3, governments and central banks.
To manage and stabilize this massive interconnected system we've been talking about, we rely on two completely separate powers. On one side, we have fiscal policy, which is controlled by the government. Governments collect taxes, and they spend money on things like infrastructure, healthcare, and defense. When the economy slows down, they might decide to spend more or tax less to stimulate demand. On the other side, we have monetary policy, which is controlled by central banks. They manage the actual money supply and set interest rates to maintain price stability and basically try to keep that inflation monster under control.
Now, a totally crucial factor in how this works is central bank independence. Central banks, which are often called the banks of the banks, generally operate independently from political leaders. And the reason for this is structural. Let's be real. Politicians often love low interest rates and high spending right before an election to give the economy a quick sugar rush, but that can seriously risk triggering inflation down the line. So an independent central bank is designed to step in and make the tough, sometimes deeply unpopular decisions that are necessary for long-term stability, completely free from the pressure of election cycles.
Let's move to and see how this builds in Section 4, the global economic stage.
We're zooming out even further now, beautifully past our own borders, to look at international trade. When countries interact, they obviously use different currencies, which means we need exchange rates. A floating exchange rate is determined entirely freely by supply and demand. So, if a country is growing really fast and foreign investors want to buy assets there, the demand for that currency rises and its value strengthens. Easy, right? Conversely, a fixed exchange rate is when a government or central bank actively intervenes to peg their currency to a target, like the US dollar, just to maintain predictability.
When we look at the flow of goods between these countries, a huge metric is the trade balance. That's just the difference between a country's exports and its imports. A trade surplus means a country is selling more than it buys, while a trade deficit means it's buying more than it sells. But hey, context is everything here. A deficit isn't automatically a bad thing, and a surplus isn't automatically a good thing. For example, the United States often runs a trade deficit, but it also attracts massive foreign investment. It's really about why the deficit exists in the first place and how the country is utilizing those imported resources to grow.
And that brings us to our final stop, Section 5, measuring growth and recessions.
So, how do we actually know if all of this global activity is, well, working? We need to look at the official economic scoreboard. The ultimate metric here is GDP, or gross domestic product. It measures the total value of all goods and services produced inside a country's borders over a specific period. But it is super important to remember that GDP measures production, not wealth. It only counts official economic activity. It completely ignores informal activity or the massive amount of unpaid work happening in households every single day.
But wait, we absolutely must adjust GDP for inflation to get the real picture. So the crucial point is this relationship right here, 2%. Imagine a country's nominal GDP, just the raw numbers, grows by 10% in a year. Sounds pretty robust, right? But if inflation during that exact same year was 8%, your money lost 8% of its value. Therefore, your real GDP growth, the true increase in actual economic output, is only 2%. Real GDP is the absolute essential metric for identifying true economic expansion rather than just rising costs.
Because of all these interconnected forces we've talked about, economies breathe in a natural, rhythmic phase called the business cycle. We usually start in expansion, where spending rises, business is higher, and confidence is super high. But eventually, we hit a slowdown, losing some of that momentum. If spending drops hard enough, we enter a recession, which is officially defined as 2 consecutive quarters where the economy actually contracts. Unemployment rises and, yeah, things get tough. But eventually, prices adjust, central banks step in to lower those interest rates, and we enter recovery, where spending returns and the whole cycle just begins all over again.
Which leaves us with this final, incredibly important question for you to ponder. Look around at the news, look at the interest rates, check out the economic calendar. What phase of the business cycle do you think we are in right now? Because honestly, understanding macroeconomics isn't about perfectly predicting the future. It's about decoding the environment around you so you can make much smarter financial decisions in your own life. I really hope this explainer helped decode the macroeconomic engine for you today. If you enjoyed this deep dive and want to keep learning about how our world works, please be sure to subscribe to my channel for more videos. Keep learning, stay curious, and I will see you next time.